Hello everyone. Today we will learn about valuation ratios. Valuation in general is the estimate of the worth of something. In the context of investments, something refers to the price of a stock. When making an investment decision, irrespective of how attractive the business appears, what matters finally is the valuation of the business. Valuations dictate the price you pay to acquire a business. Sometimes, a mediocre business at a ridiculously cheap valuation may be a great investment option as opposed to an exciting business with an extremely high valuation. The valuation ratio helps us to develop a sense on how the stock price is valued by the market participants. These ratios helps us understand the attractiveness of the stock price from an investment perspective. The point of valuation ratios is to compare the price of a stock for the benefits of owning it. Like all the other ratios we had looked at, the valuation ratios of a company should be evaluated alongside the company's competitors. Valuation ratios are usually computed as the ratio of the company's share price to an aspect of its financial performance. We will be looking at the following three important valuation ratios: price to sales, that is PS ratio; price to book value, that is PBV ratio; and price to earnings, that is PE ratio. Continuing with Amar Raja Batteries Limited example, let us implement these ratios to see how ARBL fares. The stock price of ARBL is a vital input used to calculate the valuation ratios. As we are analyzing the reports of 2014, ARBL was trading at 661 rupees per share. We also need the total number of shares outstanding in the ARBL to calculate the above ratios. If you recollect, we have calculated the same in previous video. The total number of shares outstanding is 17.08 crores. Price to sales (PS ratio). In many cases, investors may use sales instead of earnings to value their investments. The earnings figure may not be true as some companies might be experiencing a cyclical low in their earnings cycle. Additionally, due to some accounting rules, a profitable company may seem to have no earnings at all due to the huge write-offs applicable to that industry. So, investor would prefer to use this ratio. This ratio compares the stock price of the company with the company's sales per share. The formula to calculate the PS ratio is price to sales ratio is equal to current share price divided by sales per share. Let us calculate the same for ARBL. We will take up the denominator first. Sales per share is equal to total revenue divided by total number of shares. We know from ARBL's P&L statement the total revenue is 3482 crores. Number of shares is 17.08 crores. Sales per share is equal to 3482 divided by 17.08. Therefore, the sales per share is equal to rupees 203.86. This means for every share outstanding, ARBL does 203.86 rupees worth of sales. Therefore, price to sales ratio is equal to 661 divided by 203, that is equal to 3.24x or 3.24 times. A PS ratio of 3.24 times indicates that for every rupees 1 of sales, the stock is valued rupees 3.24 times higher. Obviously, higher the PS ratio, higher is the valuation of the firm. One has to compare the PS ratio with its competitors in the industry to get a fair sense of how expensive or cheap the stock is. Here is something that you need to remember while calculating the PS ratio. Assume there are two companies, Company A and Company B, selling the same product. Both the companies generate a revenue of rupees 1000 each. However, Company A retains rupees 250 as PAT and Company B retains 150 rupees as PAT. In this case, Company A has a profit margin of 25% versus Company B has 15% profit margin. Hence, the sales of Company A is more valuable than the sales of Company B. Hence, if a Company A is trading at a higher PS, then the valuation may be justified, simply because every rupee of sales company A generates, a higher profit is retained. Hence, whenever you feel a particular company is trading at a higher valuation from the PS perspective, do remember to check the profit margin for cues. Price to book value (P/BV ratio). Before we understand the price to book value ratio, we need to understand what the term book value means. Consider a situation where the company has to close down its business and liquidate all its assets. What is the minimum value the company receives upon liquidation? The answer to this lies in the book value of the firm. The book value of a firm is simply the amount of money left on table after the company pays off its obligations. Consider the book value as the salvage value of the company. Suppose the book value of a company is 200 crores, then this is the amount of money the company can expect to receive after it sells everything and settle its debts. Usually, the book value is expressed on a per share basis. For example, if the book value per share is rupees 60, then rupees 60 per share is what the shareholders can expect in the case the company decides to liquidate. The book value can be calculated as follows: BV is equal to share capital plus reserves excluding revaluation reserves divided by total number of shares. Let us calculate the same for ARBL. From ARBL's balance sheet we know share capital is 17.1 crores, reserves are 1345.6 crores, revaluation reserves is equal to nil, number of shares is 17.081. Hence the book value per share is equal to 17.1 plus 1345.6 minus 0 divided by 17.08, that is equal to 79.8 per share. This means if ARBL were to liquidate all its assets and pay off its debt, rupees 79.8 per share is what the shareholders can expect. Moving ahead, if we divide the current market price of the stock by the book value per share, we will get the price to the book value of the firm. The PBV indicates how many times the stock is trading over and above the book value of the firm. Clearly, higher the ratio, the more expensive the stock is. Let us calculate this for ARBL. We know the stock price of ARBL is 661 per share. BV of ARBL is 79.8 per share. Therefore, PBV is equal to 661 divided by 79.8, that is equal to 8.3x or 8.3 times. This means ARBL is trading over 8.3 times its book value. A high ratio could indicate the firm is overvalued relative to the equity book value of a company. A low ratio could indicate the company is undervalued relative to the equity book value of the company. Price to earnings (PE) ratio. The price to earnings ratio is perhaps the most popular financial ratio. Everybody likes to check the PE of a stock because of the popularity the PE ratio enjoys. It is often considered the financial ratio superstar. The PE of a stock is calculated by dividing the current stock price by the earning per share (EPS). Before we proceed further to understand the PE ratio, let us understand what earnings per share stands for. EPS measures the profitability of a company on a per share basis. For example, assume a certain company with 1000 shares outstanding generates a profit of 2 lakh. Then the earnings on a per share basis would be 2 lakh divided by 1000, that is equal to 200 per share. Hence the EPS gives us a sense of the profit generated on a per share basis. Clearly, higher the EPS, better it is for its shareholders. If you divide the current market price with EPS, we get the price to earnings ratio of a firm. The PE ratio measures the willingness of the market participants to pay for the stock for every rupee of profit that the company generates. For example, if the P of certain firm is 15, then it simply means that for every unit of profit the company earns, the market participants are willing to pay 15 times. Higher the PE, more expensive is the stock. Let us calculate the PE for ARBL. We know from its annual report, PAT is 367 crores, total number of shares is 17.08 crores. Therefore, EPS is equal to PAT divided by total number of shares is equal to 367. 17.08 is equal to rupees 21.49. Current market price of ARBL is 661. Hence, PE is equal to 661 divided by 21.49, that is equal to 30.76 times. This means for every unit of profit generated by ARBL, the market participants are willing to pay rupees 30 to acquire the share. Now assume ARBL's price jump to 750 while the EPS remains at 21.49. New PE would be 750 divided by 21.49, that is 34.9 times. While the EPS stayed flat at 21.49 rupees per share, the stock's PE jumped. Why do you think this happened? Clearly, the P/E ratio jumped because of the increase in the stock price. As we know, the stock price of a company increases when the expectations from the company increases. Key points. P indicates how expensive or cheap the stock is trading at. Never buy stocks that are trading at high valuations. I personally don't like to buy stocks that are trading beyond 50 times its earnings, irrespective of the company and sector it belongs to. The denominator in P/E ratio is the earnings, and the earnings can be manipulated. Make sure the company is not changing its accounting policy too often. This is one of the ways the company tries to manipulate its earnings. Pay attention to the way depreciation is treated. Provision for lesser depreciation can boost earnings. If the company's earnings are increasing but not its cash flows and sales, then clearly something is not right. Today we have completed analysis of valuation ratios. From next video onwards, we will learn about how to do equity research. Thank you for watching this video. Please do like, comment, share this video, and don't forget to subscribe to my channel.